The Buffett indicator is the ratio of total U.S. stock market valuation to GDP. Named after Warren Buffett, who called the ratio the single biggest measure of where valuation stands at any given moment. Buffett has since walked back those comments, hesitating to endorse any single measure as either comprehensive or consistent over time, but this ratio remains credit to his name. To calculate the ratio, we need to get data from both metrics, total market value and GDP. So, in today's video, we will see what are the views of Warren Buffett on the current U.S. stock market. Without further ado, let's begin. Warren Buffett's Berkshire Hathaway bit big on the U.S. stock market in the first quarter, buying $51.1 billion of shares as he put the sprawling conglomerate's cash pile to work as financial markets slid from record heights. It is a dramatic shift from an investor who had been a seller of stocks for the past 2 years, warning of high valuation and little in the market that would generate substantive returns. But global financial markets have weakened in recent months as Russia invaded Ukraine and fears of a Chinese economic slowdown have rattled investors' confidence. That has offered him a more attractive entry, according to analysts and investors who have been warmed by the vote of confidence in the stock market from the so-called Oracle of Omaha. The furious pace of stock purchases was enough to put a dent in Berkshire's cash pile, which Buffett has often likened to a war chest. Its cash fell to $106.3 billion at the end of March from just under $147 billion at year-end. The company's first quarter report showed it had sold $9.7 billion of stocks during the period, indicating it was a net buyer of $41 billion of shares at the start of the year, among its most attractive quarters in recent memory. Stocks have endured a terrible start of the year as investors fret about soaring inflation and the Russia-Ukraine war, but the pullback still doesn't look like a great buying opportunity per a tried-and-true measure used by legendary investor Warren Buffett. The Buffett indicator, as it's called by legions of devotees, which takes the Wilshire 5000 index viewed as a total stock market and divides it by the annual U.S. GDP, is still hovering around a record high even as stock prices are well off their record levels. The report showed Berkshire had sharply increased its ownership of energy company Chevron, listing its $25.9 billion stake as one of its top 5 holdings in the stock portfolio, now worth $390 billion. The investment in Chevron accompanies billions of dollars worth of stocks purchases in oil major Occidental and printer and computer manufacturer HP this year. Buffett said on Saturday that he had also directed the company to purchase millions more shares in Activision Blizzard, the gaming company that Microsoft agreed to acquire in January. Berkshire had bought just under 15 million shares, less than 2% of the outstanding Activision stocks, last year before the deal was agreed, purchases directly by one of Buffett's 2 investment lieutenants. Berkshire now owns 9.5% of the company, he said, which would make it the largest shareholder. The 91-year-old chief executive added that he was keen to take advantage of the discount at which Activision shares were changing hands on the market compared to $95 a share price Microsoft agreed to pay. To fund those investments, as well as $3.2 billion spent during the quarter on share buybacks, Berkshire sold down or let treasuries and other securities worth more than $44 billion mature in the quarter. Buffett has burnished his deal-making credentials in recent months after sitting on the sidelines for much of the pandemic era. In March, he clinched an $11.6 billion deal to take over insurer to toy manufacturer Allegheny. The figures were disclosed on Saturday as tens of thousands of Berkshire shareholders descended on Omaha to hear from the billionaire investor at the company's annual meeting, the first one held in person since 2019. Berkshire reported a net income of $5.5 billion in the first 3 months of 2022, less than half the level generated a year earlier. The company's results included a $1.6 billion hit from losses on its investments and derivatives portfolio. Excluding those swings, which Buffett has criticized as usually meaningless, as U.S. accounting rules required changes in the value of its investment portfolio to be included in quarterly results, the company reported operating earnings of $7.04 billion. That was marginally above year-ago earnings. The results showed the company's railroad, utilities, and manufacturing business reporting stronger profits in the quarter compared to year-ago levels. Revenue at the BNSF Railroad, which Buffett described in a February letter to shareholders as one of the conglomerate's four giants, climbed 11% to $5.8 billion. The company warned that supply chain distribution, including lower auto shipments because of chip shortages, had weighed on shipping volumes. Further, the development of geopolitical conflicts in 2022 has contributed to disruption of supply chains, resulting in cost increases of commodities, goods, and services in many parts of the world, it added. In looking at the numbers, the Buffett indicator stands at about 168.1%, down sharply from highs above 202% in August 2021, per data from Guru Focus. The stock market is significantly overvalued, according to the Buffett indicator, said researchers at Guru Focus. Based on the historical ratio of total market cap over GDP, currently at 168.1%, it is likely to return to 0% a year. From this level of valuation, including dividends, the Buffett indicator rose to fame after a 2001 Fortune magazine written by Buffett and longtime Fortune writer and Buffett insider Carol Loomis. The ratio has certain limitations in telling you what you need to know. Still, it is probably the best single measure of where valuation stands at any given moment, explained Buffett. Seeing the Buffett indicator still in significantly overvalued territory is interesting for a few reasons. The gross domestic product, GDP, represents the total product of the U.S. economy. This is measured quarterly by the U.S. Government Bureau of Economic Analysis. The GDP is a statistic measured of prior economic activity. It does not forecast the future or include any expectation or valuation of future economic activity or economic growth. The GDP is calculated and published quarterly, several months in arrears, such that by the time the data is published, it is several months old. In order to provide updated data for the most recent quarter, we used the most recent GDP Now estimate published by the Federal Reserve Bank of Atlanta. Based on this, our current estimate of annualized GDP is $24.5 trillion. Given that the stock market value represents the present value of expected future economic activity, and the GDP is the measure of the most recent economic activity, the ratio of these two data series represents expected future returns relative to current performance. This is similar in nature to how we think about the P/E ratio of a particular stock. It stands to reason that this ratio would remain relatively stable over time and increase slowly as technology advances allow for the same labor and capital to be used even more efficiently. There is much more complexity around this, which we'll mention in more detail below, but high levels there should not be reason to think that this ratio could continue rising or falling over time. So guys, let me know your thoughts down in the comments section below. For more interesting content, give this video a thumbs up, and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I'll see you in the next video.